Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Let's take a closer look now at the Tencent story, and also, while we're at it, look ahead to the earnings from Alibaba. Robert Lee is with us. He is Bloomberg Intelligence Senior Analyst, joining us from our studios in Hong Kong. Robert, thank you so much. Talk to me about the way in which you saw the Tencent results. What do we know now that we didn't before?
Okay, thanks for having me on. Good question. Expectations into Tencent's results were quite high. It was well known that their gaming business was seeing a renaissance, largely driven by, very stellar strength coming through in one particular title called DNF Mobile, and indeed that's what they delivered on. So on the gaming front, they actually came in ahead of expectations. And at the adjusted operating income level, they were 7% ahead, benefiting from a lower tax rate overall. They were close to 20% ahead at the bottom line. So these were very strong numbers. So whilst expectations were high, they did smash on most metrics. I think the only area of potential medium-term concern is their fintech business. Fintech, which they're lumping with their cloud computing business. Cloud is quite small for them, by the way. Did miss expectations on the top line for the second quarter on a row. And there are, read across to the state of consumer health within the Chinese economy there. But again, I think that was anticipated, well known, and that business actually beat at the margin level due to a mix shift and with some cost cutting. So overall, I think they were good numbers.
These days, when you talk about the cloud, you talk about artificial intelligence usually. Is that the case with Tencent?
Now, I think compare and contrast with a lot of their local peers or even peers, in the US or other parts of the world. They've really been playing, I would describe it, the long game in AI. It's been conspicuous, the lack of comment on AI in their earnings release is really conspicuous compared to a lot of others. I mean, absolutely, they're investing in AI. They've got a cloud business. There's a lot of steady investment going on there. But their focus is more on areas they can generate a more immediate return. So I think actually that's to their benefit, and given the way we see that the whole AI and cloud story evolving at the moment, and particularly in China, there are price wars in both sectors, I might add, which some people may not be aware of. So I think in taking a sort of longer term view and taking a sort of slow and steady pace and not being caught up with the hype and hyperbole, I think that's really been to their benefit, and they're clearly delivering in the other core areas of the business.
You were talking a moment ago about the weakness in the Chinese consumer. That really shouldn't come as much of a surprise, but I'm curious as to whether or not there are variations across different demographics. I mean, if I'm talking about gaming, I'm thinking in my own mind that you're looking a little bit at the younger crowd, and maybe they have a little bit more spending capacity. I don't know. I mean, is there some differentiation across the demographics?
Again, we could talk about this for a long time. There are a few contradictory factors here, because I think it's well known the level of youth unemployment in China is actually quite high. However, I think, and as the father of a teenage son myself, I think he would spend his last dime on games. Games is probably the sole focus of his life at the moment. His dating, he's a bit ahead of his dating game. So once he discovers the other members of the opposite sex, perhaps things will change. But I think, gaming is a major pastime in China, as with much of Asia. And yes, it is mainly a younger demographic. But there are the odd people sort of closer to our age that indulge in it as well. But the slowdown on the Chinese consumer side has been known for some time. And I think how Tencent compares or contrasts with Alibaba is far more exposed to the purchase of big ticket items, whereas a lot of Tencent's fintech business is more revolves around day-to-day spending on lunches, coffees, taxis, that type of thing. And you might argue that's more less discretionary nature, it's more essential, and therefore should hold up a little bit better in relative terms in a slowing consumer environment. So again, it doesn't make it immune from slowing consumer strength. But as I said, I think it makes it slightly more resilient. But from our point of view, the key thing is the margin on that side was ahead.
So I'm glad you brought up Alibaba, because tomorrow morning U.S., before the opening bell, we'll get the numbers. The ADRs will trade, I guess, before the shares in Hong Kong. Is there anything that we should know about what Baba has been up to and what we may learn tomorrow?
Okay, very briefly, I mean, strategically, they were going to spin off their businesses a year ago. They then did a 180-degree about turn on that. They have been putting huge effort into trying to stabilize and regrow their market share, having come under, intense competition from low-cost disruptors like Shein and Temu. So absolutely, I would imagine we should see evidence of them, as I said, stabilizing or regaining some share, but at what cost to the margin? So I think that's the big risk point or danger point that people should focus on there. It's intensely competitive. And again, given the backdrop of slowing consumer growth, so there's a risk that they could miss on margin front. And also, from their strategic point of view, they see AI and cloud computing as the core drivers of their future growth. As I mentioned a moment ago, both those sectors are locked in pretty vicious price wars at the moment. So again, there's a potential negative margin impact there.
It's very interesting because we were talking about kind of the e-commerce side of the business. I'm equally curious about what's going on with digital media and entertainment at Alibaba, since we were talking kind of about the game market in China. Is the same trend going to show up when you're talking about kind of the pullback in spending? Is it going to show up in digital media and entertainment as well?
So I guess, again, sort of focus more on the game front, or even some of the streaming service. So there's a company called iQIYI, which is essentially the Netflix of China, you may say. Yes, but these end markets have built up very rapidly in the last 10, 15 years, and they're at a sort of saturated point at the moment. So the growth outlook within them isn't particularly, bullish, I would say. And again, they are subject to slowing consumer. So we are seeing heightened levels of competition in those sectors as companies fight it out to either retain their market share or build market share. And I think, to the detriment of margin again. So that's a trend we're seeing on that media and entertainment side as well. So I guess the question is, where are the real growth drivers in China at the moment? I think AI will ultimately evolve into one. But, given we're locked in a price war at the moment, no one's going to make profit this year or next in it.
Yeah, I don't know if you saw this. In the U.S. session, we learned that Michael Burry further increased his stake in Alibaba, while at the same time, interestingly, reducing his overall equity portfolio in half. That's quite a dramatic cut. That happened during Q2. Very quickly here, Robert, when we talked about Tencent in the past and Alibaba, there was always this looming cloud of a little bit more on the regulatory front. Is that dissipated completely? Very quickly.
Okay, buzzword of the year has been new productive forces. The Chinese government looks to the tech sector as a major driver of future economic growth. Alibaba and Tencent are the two largest companies, with ByteDance and Huawei as well. They're stalwarts of the economy. They therefore need to be on good relations with them. Therefore, the regulatory environment and outlook is more stable and should remain that way.
Robert, it's always a pleasure. Thanks for making time to chat with us here on Daybreak Asia. That is Robert Lee, Bloomberg Intelligence Senior Analyst, joining us from Hong Kong, looking at what we heard today from Tencent and what we may hear tomorrow from Alibaba. Let's bring in Keyu Jin. She's in Beijing. Good of you to join us. Aren't you normally based in London?
I am, except for the summer holidays.
All right. Are you having a good summer in China?
Very hot, as you can imagine.
So what's your view on the economy? How well is it doing, just anecdotally?
Anecdotally, and whether it's in the data or anecdotes or micro level or macro level, it's all doing pretty poorly compared to China's economic potential.
So you're based in London, and I'm sure you're being very good about keeping up with a lot of the economic indicators. Is it worse than you imagined?
It is getting even worse than we had previously expected. And of course, I speak frequently to policymakers and to entrepreneurs, and I spend a third of my time in China. So you feel that on the ground. It's particularly frustrating, given that I still believe there are lots of things that can be done to save the economy, to put the economy on a very normal path, which is, going to be pretty good, given that there's so much untapped potential. I mean, China's nowhere near done with economic reforms or economic growth, moving it along to the kind of more rich income status. I think the proximate factors, which we talk about, is really real estate dragging down investment, dragging down confidence. But I think there has also been a deeper issue at the heart of this, which is a shift away from economics as front and center objective into other issues like national security and social considerations.
One of the things that I was just thinking about today, this move on the part of the central bank to do what may have been called in the version that we got in the United States and in Europe, quantitative easing. How well is that working, or maybe why isn't it?
Well, if you look at the Chinese economy, it's not the overall economy, that's to say, it's not as sensitive to interest rate cuts. And so there's room to cut, and you can do that further. But monetary policy has been less and less effective over the last few years, and part of the reason comes back to a fundamental institutional constraint, which is the financial system. If you look at the structure of financial system, many institutions are state-related, state bank dominant, and they prefer to lend to state enterprises. So when you actually get the credit to where it's most needed, and the interest rate cuts, the real economy, that's to say the private enterprise, small, medium firms, their cost of capital is extremely high. So it doesn't really work for them, but they are the ones that need or are sensitive to these interest rate costs.
Is there a real risk that there's going to be a protracted problem with deflation and the type of situation that it will be extremely difficult from which to emerge?
Well, currently the deflation is primarily driven by food prices to a certain extent, and we're not seeing the repeated patterns of ultimate deflationary trends quite some yet. But yes, if this prolongs for longer period of time, then there could be an overall level of deflation, which the government is trying to counter. If you look at more specifically the service sector, that's actually doing pretty okay. There's a greater demand in services. If you look at the recent performance of the Chinese economy, whatever has to do with outward-oriented economic sectors like exports, like manufacturing, like high tech, it's doing okay. Wherever it's related to internal demand issues, it's much, much weaker. I wouldn't worry about deflation just yet, but again, a longer, more sustained period of time, that becomes a real problem.
Should we be concerned about a lost generation of young people in China?
Possibly, but I would say that that's also a global phenomenon as well. The high unemployment rate currently is still potentially a cyclical phenomenon. I think that if you look at the number of jobs that are available, there are still many, many jobs available. In manufacturing, something like 25 million until 2025, hundreds of thousands of talent gap in semiconductors. But there's really a skill education mismatch. These young children study a lot. Their parents spend a lot of money financing their education. They can't find the jobs they want because the structure of the economy is not geared towards them. To open up the service sectors, promote vocational training education, and I think we can avoid that.
You were talking a moment ago about the government spending heavily on kind of military hardware and the like. I know you're an economist by training, but to what extent is geopolitics now becoming a factor, not just in terms of building up military hardware, but in the possibility that we could be looking at, or China could be looking at, some new tariffs from the U.S.?
All of that geopolitical shifts have really shaped the direction of the Chinese economy, focusing on high tech. And this is not just the military aspect of it, but also the pursuit of technological independence, because there's an existential fear, not only of the Chinese government, but also Chinese enterprises, that they will be cut off from the critical components that are needed, that they need. And so there's been a focus on high tech and innovation. And of course, course, that is not big enough, despite its success in China, to offset the real estate downfall. And of course, tariffs, that's going to be a looming theme. But we're seeing lots of trade reorganization from Vietnam to Mexico and other potential places to counter some of that trade tension.
Great conversation. Thank you so much, Keyu Jin from Beijing, joining us here. We'll have to have you back for some more conversation. And her book is The New China Playbook. It's a worthwhile read. You can get that at your local bookstore. Jamie Battmer, he is Chief Financial Officer at Creative Planning, joining us from Kansas City. So are you a Chiefs fan? I would imagine that the answer is yes, right?
Oh, absolutely. Born and raised, lived all over the world, lived in Asia, but being a Kansas City Chiefs fan, hearing that Taylor Swift is juicing the revenue by 30%, you have to love it.
Yeah, that's right. So when you look at the equity trade right now, what's going to juice the returns for the equity market?
Yeah, I mean, what typically juices the returns, keeping calm and carrying on and taking advantage of volatility brought on by others and their panic selling. Specifically in the Asian markets, obviously the dislocation that occurred last Monday in the carry trade, the yen carry trade. And really, what happened then is what's kind of at the core of our overall investment philosophy is that the short-term traders are punished, but long-term investors can actually benefit from it. Using that volatility to actually rebalance, move money from more conservative assets into aggressive assets, not making a specific market call, but just that redeployment from a conservative bucket to an aggressive bucket. When markets have these occasional dislocations like this that we haven't seen in several years, it works out in the short run, and it always works out in the long run. And again, we're happy to report that it did work out in the short run here. And we had 4 of the best trading days of the year right on the heels of the volatility. So the hot dot is always keeping calm and carrying on when others are dislocated because of fear or greed.
We heard from a former BOJ member in the last week. He was saying that the BOJ is probably not going to be able to move until next March. So if you accept that notion, give me your sense of how well the Japanese economy is performing right now and whether or not there's a risk that things deteriorate.
Yeah, being a localized issue became a very global macro issue. So it's kind of forcing the BOJ's hand as they were finally kind of making an adjustment off this zero bound or negative bound interest rate environment that they've been in for decades. Even it's kind of going against the grain of global central banks, the need to, reduce interest rates. But now that kind of is being forced to be put on hold. So yes, it's really, it can be a challenge. It could stall out the economy more after we finally see momentum in seeing kind of growth, and especially growth in the equity markets that we hadn't seen in quite some time. So yeah, these macro concerns are kind of forcing their hand, pushing them into a corner that could lead to further deterioration in the overall market.
And the number of conversations that I've had on this program with guests that know Japan very well point to the problems in China, and they make that connection. As long as China remains weak, Japan is going to be hurt by that. Would you agree with that? I imagine you would.
To an extent, yes. But, again, speaking for our particular client base, we manage approximately $350 billion in assets. And everything we do is driven by the historical empirical data and academic research. And so we want that global presence. We're actually encouraging clients to stay in the international markets, stay in the emerging markets, not running from them, not chasing the hot dots of domestic technology. And yes, while mainland China is suffering, some policies, the policies that could be, argued as non-growth oriented, they're not the alpha dog they were before. You factor in kind of, the EM world is kind of becoming more multipolar. And yes, mainland China just dominated just a few years ago, but, India's caught up, got on parity. Taiwan's caught up, gotten parity. And so, a really healthy kind of diversification play within that. And so hopefully, even though mainland China stutters in Japan being so close to the world's second largest economy, I feel like the flows to other markets kind of within that segment, or at least comfort with our investors, and we're encouraging them to maintain or extend those positions, will hopefully be seen as a positive and not nearly as dependent as mainland China as it has been in the past. And again, just the overall dynamic of emerging market indexes and those other markets catching up, I think is testament to hopefully be able to reduce that overall dependence.
So away from EM, how are you feeling about the U.S.? And if you could, talk to me about the proportion of EM relative to, let's say, U.S. domestic equities. I mean, what's the balance for you right now?
Yeah, I mean, as I mentioned, we let the historical empirical data and academic research drive all of our decision making in the public markets, and really just trying to avoid, that hot dot chasing. It's like that friend that's always wearing the hottest trends, or working at the hot store, the Buckles, and the late '90s had frosted tips hair, and then constantly changing. Well, you're just chasing the trend of the moment, and you're probably losing out on the accretive value of prudence over the long run. And so we're telling our clients, hey, stick with it. Yes, it has been the decade of large cap domestic U.S. growth. But again, success is measured in decades, not a 10-year period, not a 5-year period, not even shorter than that. And you only have to step back to the decade before, kind of the first decade of the new millennium, where for an entire 10-year period, the S&P 500 was down about 10%. Large cap growth, domestic U.S. large cap growth was down a full 33%.
Yeah.
While emerging markets was up almost 200%. Small caps are up 100%. So you have to keep calm, not chase the hot dot, and make sure you have a globally diversified portfolio based upon global market capitalization rates.
But to be fair, everyone has their own individual time horizon, and we may not have 10 years. I may need to capture, a return, let's say, in half that period of time. Let's say I'm looking at 5 years out before, is a part of my calculus in decision making. When you consider the AI trade, I mean, that's really been a big part of the narrative here in the States for much of 2024. Is this something that you still think, in terms of the way that you analyze trends and look at the fundamentals, all the research that you bring to the table, do you still buy into AI?
Well, again, the trends like those hot dots, they come and go. What's vogue today is out of fashion tomorrow. When disco was hot, then it was the 80s, and it was grunge, listening to Pearl Jam, moving on from there. And so the hot dot is always changing. So you just you cannot get married to whatever the hot dot of the moment is. Yes, you participate in it, but you're not beholden to the individual names. Just right before we came on, you guys were referencing Cisco's earnings. Well, Cisco is still essentially 70% below its market peak during the last technology bubble we had. But the overall markets are up hundreds of percents over that time. And so you ride the waves of the momentum. Yes, will AI, materially move the economy, the world forward? Maybe. But regardless, it just as the internet, again, it eventually moved the world forward. But there were these moments where it was challenged at the time period. And not getting focused on the individual names will win out 100% of the time over the long run.
We'll leave it there. Jamie, always a pleasure. Thanks for joining us. Jamie Battmer, who is a Chief Investment Officer at Creative Planning, joining us from Kansas City. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.